Good day. Ira Epstein with your financial market wrap-up. And this is for Wednesday, the 5th of February, 2020. And the time right now, just after 5:05 p.m. Central Time. Well, the event of the day, of course, had to be President Trump acquitted on both charges. Mitt Romney was apparently the only Republican that on one of the charges crossed over on the other side. In looking at the coronavirus, the market is saying things are getting better. I'm hearing Foxconn is still on to try to open up one of its plants. The Chinese are saying out of one of their universities that they think they have found a vaccine. They're going to put it into tests right away. I think Gilead is the company that's involved with that there. And others from the WHO, World Health Organization, are saying not so fast. They're not into that. Yet the market, you can see up in the energy, so I think that the market's believing that there could be something happening here. Up in the stock indices again, down in the metal markets, and pretty flat in the foreign currencies. Now, as we take a look at the S&P here, this is a new high close that the market has made. So that's a weekly chart of closes, and you're up. It's only midweek, right? We're already into Thursday trade, but you're up 113 points. This break didn't last very long in the marketplace. That's about all that I can say about it. And you can see once again, the market on these breaks just is the never-ending bull market. It just doesn't seem to die. The pattern is nothing. Now, that's my problem. When I look at patterns, here's what I looked at on the chart. And as you can see on this day right here, we had an outside day down, and that day was January 31st. Seems so long ago, Friday. If that high were taken out Monday or Tuesday, well, what happened there? Tuesday takes it out. I call that a bear trap. That's my definition. So 2 time frames, 2 periods after that occurs, if it's taken out because the outside day down, that's a trap. Until it takes out this low, I'd be looking for the market to try to move higher to the closest of a moving average above the market or the Bollinger Band top. This is what the market's done, and this is the follow through tonight. So now let's put on the moving averages. All of the moving averages were under this move that took place 2 days ago. Therefore, the only number I have left is a Bollinger Band right through here, and this is where it comes in, 33.57. I don't have a trend because I have a lower low, higher high pattern, and I have an overbought market. It'll be interesting to see if the market wants to reach up there or not. Don't know that it will or won't. Support back at the 18-day average, but what volatility this market has had between the upper Bollinger Band and the lower band, and it's overbought. The NASDAQ is trying to pull back inside of the Bollinger Band. Keep in the back of your mind always that this algorithm called the Bollinger Band is built so that the markets will trade within them 95% of the time. That means 5% they're going to be out. Now, there's an art to looking at it. Is the market coming out of sideways action like it did here to get up and over it, or is it from broader action? Broader action is hard to stay over because you've used not as much power. If you think about it, think of a pipe and you got a spring in it, you're winding it up. One way or the other, when it breaks out, it's got more power going for it. So less volatility brings in the bands, more volatility widens them out. In the Dow, I see an overbought market, the same pattern that I had, or is it? This was the high, let's go right here, of 28.81 on the outside day down. Didn't take it out there. This day, we hit 28.847. That's not the same high. So it did it a day after. It's not the same trap. That's what I'm saying. And I know you'll say, well, it looks pretty similar. I know, but the probabilities of hitting that number are not as good as we saw in the S&P. That's all it means. That's what my study work has shown me over the years, and there's no magic to it. I still don't see a trend. I'm not blind. I see a market at all-time highs, and I realize that's what's going on, but trends are normally a bit easier to work with than this, not catch. Catching trades is always hard, but that's not a trend, as I call it. Same in the Russell. Now, when the Russell, if we go to yesterday, when the market took out the high of an outside day down, that put into play, for me at least, that I think the market's going to the closest of a Bollinger Band or a moving average that's near it, and this is the higher moving average above the market. Here's the 100 and the 200, so that would be my objective, not the Bollinger Band. You did it. You're not overbought. The market's still following through. But again, I'm stuck with these patterns of lower lows, higher highs. Don't know what to do with them. In the VIX, one of the things I've been telling you is that I thought the pros back here were again into the marketplace where they think they've got their arms around the coronavirus, so selling calls. Now, that's what I think they do. I'm not saying they're selling the cash VIX or any of that. Selling calls to get back to whatever their strike is in this area is what I think they did, and I still think they're live on those trades. In the T-bond market, this is how you looked coming into finish a business Monday. I didn't put out an update for you yesterday. You had broken through this low. So the swing line trend was over. There's a warning sign here, and the word is warning. If the market would open steady to lower, you might lose the embedded reading. So it's a warning, but it wasn't quite there. Now it's there with the market today closing, as you can see, with the swing line, with the slow stochastics having lost their embedded reading. I'm thinking ahead of my talking. That often leads to price and the closest moving average coming together. This is what I'm seeing working at it. Is the trend down? No, but the momentum is lost to the upside. Now, when we get to the 10-year note, it's very similar. But the difference here is you had lost on the close of business Tuesday the embedded reading. So now in play, unlike the bonds, is the probability that if you don't go up right away on Wednesday's trade, that price and the 18-day average are going to try to make a run at each other. And that seems to be what they're finishing up right now. In the dollar index, again, I didn't do an update yesterday, but the trend has been higher lows, higher highs. And what I'm going to say again, the first time you hit a Bollinger Band, I think pros step out of markets. Now, they don't have to take their whole position off. I don't know if they're even listening to what I'm saying, but that's what I believe happens. Tight stops, and if you fall back to the 18-day average, it's like a reset on a pinball machine. Everything's live again. So until this low's taken out, I still think that they're friendly. Now, the question is, down here, is the market overbought? And the answer is yes, even though it hit that number on the way back down. Any reading that's over 70 is overbought. So I'm not sure they bought anything there. How's that for just the way that it is? And if it goes up, I'm looking for the upper Bollinger Band as a possibility of a test. The market yesterday finished like this, and today, market gets up there, and of course, I don't know where it's at tonight yet. It hasn't opened. You also had a bullish crossover. The 18-day average got over the 100 again. You've been whipping back and forth. You're going between that here and here. That's unusual. Moving averages often, when they get crossovers, they stay crossed over one way or the other. Right now, it's back to a bullish crossover, which is against what so many people thought was going to happen in their December reports. When I was reading, what do you think of the U.S. dollar for this year? Not saying everybody was bearish, but I'm saying I read a lot of bearish reports. In the eurocurrency, first thing my eye goes to is it's oversold. The second thing, lower highs, lower lows, a downtrend. Maybe you make it to the lower Bollinger Band, but oversold markets have a way of disappointing traders. You always got to be careful. Here's where you hit the Bollinger Band, and when you had the bounce, you lost the embedded reading, if you'll recall. Right here. That often leads to a challenge of the 18-day average. It all happened like that. It generally doesn't. You saw what happened in the 10-year notes. So let's see what happens from here, if the market has the power to really continue down or not. British pound, I just see a whipsaw in sideways action. This is very important to start watching. If you have a notepad, write down British pound going sideways. So as volatility has come out of the market, the bands are tightening up. And as the bands tighten up, it's like a spring inside of a pipe, and you're just winding it up, and eventually you get a thrust one way or the other. At this point, there's no edge. You have a higher high, a lower low on the market, and you keep coming back to this 18-day average and springing around those bands, just a whipsaw market. Japanese yen has stepped out of its uptrend. In fact, it did it yesterday. This is how the market looked Monday. Had hit the upper band. You know what I'm going to say. It hit the band the day before. This was just now in between that band and the 100-day average. I think pros come out at those numbers. That does not mean they're bearish. Market yesterday then fell back, okay, and took out this low. So now I'm without a trend, as I have the way that I teach charting at least, a higher high and a lower low. The bias is down, momentum's down, but I don't see a trend down. And here's the market just continuing to slip, and you can see even tonight it's doing the same. Here's what I'd be watching. You're already in oversold territory. Any number under 30 to me is oversold. Bitcoin. Bitcoin was super interesting. We talk about embedded readings. Embedded means the red and the blue, which are the K and D lines, go sideways over 80 or sideways under 20 for 3 days or more. When that happens, it means that you've converted from being overbought or oversold into a locked-in trend until that's lost. Well, what you did is you lost that yesterday. That's a get-out sign. Now, if the market's going to regain the number, and it's rare you do it when you drop 8 points away from an 80 level, then the Bollinger Band comes into play. That's exactly what occurred today. So this was a real whipsaw of a day. And what have you done? You've locked in the Bollinger Band again. So the trend is back to the upside. It's never been down. But when you lose the Bollinger Band, you're often looking, the slow stochastics, you're often looking if you can get back to the 18-day average. Didn't happen. Then we get to the differential of the April Brent versus April crude oil. Look at how this market went from this 5.25 zone back to 424. Pretty interesting what it's done. And that's all during a big crash in energy prices. And even with the market up tonight, and this is Brent, so it won't be open yet. This is the close of business on Wednesday. You still have the embedded reading. When I come over to the WTI, which is now open because we're after 5 o'clock, you still have it. So I think the bears have not been scared out of this market. Lose the embedded reading, I think they get scared. And the market is, each time it's hit the lower bands, it's managing to move to the right-hand side of them, which, if you think of a trend line, it's still holding that trend line down. I don't see a turn in this yet. In the gasoline market, if ever anybody was wrong, it's me. I did not think this market was going to take out that low. I really thought this was going to hold and we'd start getting a seasonal to the upside. Boy, was I ever wrong on that one. The trend remains down. The market is not embedded. It's got an oversold condition, but I didn't think that. I thought you were going to put in those seasonal lows that they'd hold. Just didn't work. There's been no reason, if you're a trend trader, to be long. You were just looking for seasonals as you've been under the 18-day average, which keeps the bias down. Remember what that is. The 18-day average on each chart I show you is a line in the sand. I view the market this way. When it's under, it bias down. If the market's under and it rallies, I'm going to look for resistance on the rallies at that number. It doesn't have to do that, but it's often what takes place. Go back on your charts and look. The second thing, it's a filter of my swing line, and it acts as something of a filter on what the slow stochastics are doing. So right now, you still have the trend down. You've still got a locked-in bearish market here. I don't see anything that has changed in this market. It's still looking to me in the nat gas in the bear camp. If you like what I'm saying here, you're probably going to love seeing our Guide to Technical Indicators, Volumes 1 and 2. A simplistic way to view and learn about indicators. Now, it's going to deal with charts, different types, bar charts, area charts, chart patterns. How do you draw trend lines? Why are they there? Believe me, there's an art to it more than a science. Look at it that way. Oscillators, there's a lot of them. I like slow stochastics. There's MACD. There's chalk and indicators. I can go on and on. There's different ones. Elliott wave, Gann theory, different ways of measuring where markets might move once they start in something. And of course, one of the most important is money management, because no matter who you are, you're going to have losing trades. So if you don't understand money management and get rid of your psyche as you're trading, you could be in trouble real fast. How do you get this? It's free from us. Just go to our website. It's under free offers and anything else you want there. In the meantime, I'm Ira Epstein. You have a good day.